Everyone. We'll be kicking off the first session on automated market making with a presentation from Jason Milionis. Jason burst onto the scene last year as a lead author on the paper introducing the seminal concept of loss versus rebalancing, or lever, and this is a paper that extends that concept on automated market making and arbitrage profits in the presence of fees. So welcome, Jason.
Hi, everyone. Thanks, Dan, for the welcoming. So today, I will be talking to you about our joint work with Siamak and Tim on the economics of liquidity provision in automated market makers. So currently, we have about $4, $5, or $6 billion locked in on providing liquidity in automated market makers. And these liquidity providers who give capital to AMMs are clearly subject to some risk. But how much is that risk, actually? So last year at SBC, we introduced Lever, along with our co-author, Anthony, to precisely account for the arbitrage losses of liquidity providers in AMMs. Since then, there has been lots of discussion on the losses of liquidity providers, and Lever has become kind of the center of focus for a big part of it. So entire research spaces have actually been devoted to figuring out ways to mitigate Lever. But of course, one question remains, that is, what about fees? And so namely, Lever was derived as the profit that is obtained by the arbitrageurs under the assumption that they can snipe prices without paying fees to the pool. Obviously, though, pools have fees, and so what we'd like to do is to actually refine our understanding given the presence of these fees. So I'm here to present to you the exciting follow-up work that we have on what happens to arbitrage profits when we introduce trading fees and discrete block times to the model. One of the main takeaways of this talk will be that the losses to the LPs that used to be Lever are now going to be, well, what a surprise, Lever again, multiplied by the probability of trade this time, which we'll see later in the talk what that stands for. And as a result of this, we saw that faster block times actually lead to our profits going down. But more than that, our work essentially shows that Lever is still a very meaningful quantity in that it is precisely split into two components, one of which is the arbitrage profits that goes to the ARBs, and the rest of it that is returned to the LPs in the form of fees. So specifically, as fees increase, Lever essentially gradually gets converted from arbitrage profits to fees that are being paid back to the AMM. So we'll first review the basic Lever model, and then I'll show you what happens when we also introduce trading fees and discrete block times to this model. So we have a risky asset, X, for example, Ethereum, and a numeraire asset, Y, for example, USDC. And we have an external market for this risky asset. For example, you can imagine Binance, a centralized exchange, that has a market price for this asset that we denote by PT. And we assume that there is someone who essentially always knows this last up-to-date market price, PT. And these people are called arbitrageurs, or ARBs for short. And now we're going to have a probabilistic model for what the market price is. And essentially, this is the standard probabilistic model in quantitative finance that is known as the Black-Scholes model, which essentially, to those of you who might not be familiar with it, a 1-minute explanation is that the price oscillates all around the place, and over small time horizons, so over a tiny delta t, essentially the returns of this asset are going to be normally distributed with some mean that depends on a drift mu, and some volatility that's essentially this sigma that you see over there. So the price curve is essentially looking something like the one that you see on the slide. And so the way we're going to use the AMMs in this work is going to be through what we call demand curves. And so essentially when we have the pool have a price P, then essentially we will say that the reserves that this pool holds are in the form of X of P for the risky asset and Y of P for the numeraire asset. And now if we have this, this definition, then we can define something that we call the rebalancing strategy, which essentially starts from the same reserves as the pool holds initially and tracks the risky asset exactly as it happens on the pool, except that it does so at market prices and not at pool prices. And so what is defined as lever is essentially the difference between the value of this portfolio of the rebalancing strategy and the value that we actually observe on the pool. And so the characterization that we gave at last year's SBC is essentially that this lever quantity is a stochastic process that's always increasing, and specifically it has an instantaneous rate which depends on the asset volatility sigma, it depends on the price P, and it depends on the marginal liquidity that the AMM provides at this price P, which is this Y prime of P that you see over there. So for example, if we imagine a constant product rule like Uniswap V2, then you might have seen by now the formula sigma squared over 8. What is that saying? That is saying that essentially, for example, with a 5% daily volatility for the asset, essentially the liquidity providers are going to lose a value of about 3 basis points daily of their portfolio value. So this corresponds to an annualized amount of about 11%. But of course, there is a key question, which is where does this money actually, is this money actually realized, right? Because all of this I showed you until now is a theoretical strategy. Well, it turns out that the people who actually implement the rebalancing strategy are exactly the arbitrageurs. And so whenever these arbitrageurs see that the AMM price is different than the pool price, then they will make trades on the pool to exploit that. And it turns out that under the assumptions in this model, namely that arbitrageurs are able to trade continuously and that they do not pay fees, the profits that the arbitrageurs are able to extract are going to be exactly that lever quantity that we saw previously. But of course, let's think about these assumptions a bit more carefully, right? First of all, you cannot continuously trade in a pool, but you can only trade when blocks are generated. And on the other hand, pools, as we've said already, have trading fees. So how do these two aspects actually affect the AMM? Let's try to relax these assumptions one at a time to make the model more realistic and see the effect that they have. So here, I'm showing you again the external market price in the red curve. And so when the arbitrageurs are able to rebalance continuously and without trading fees, then essentially what's going to happen is that the pool price is always going to match this external market price. And so in particular, the blue curve is going to be on top of the red curve. This is what we're going to observe. So now let's try to additionally add discrete block times. And so I want you to look at this particular graph over here. Let me first draw your attention to the red axis and the x-axis. These are the block generation times. So these are the times that you actually see blocks on chain. And these are the only times that the arbitrageurs can actually transact with the pool. Now, again, we do not have fees here. We only have these discrete block times. And so what will happen now is that there is periods of quiescence in between these block arrival times. And whenever a block arrives, there's a change that's being made to the pool price. And what is that change corresponding to? That change is corresponding to switching the AMM pool price back to the external market price at that moment. So this is the effect of just discrete block times. Now let's try to additionally add on top of that model trading fees as well. What is going to be the effect now to the pool price? Well, there's now going to be a no trade region actually around the current AMM pool price. And whenever the red curve is within this gray shaded region that is the AMM pool price, we're essentially not going to see any trade, even if we could see a trade. So let's see these red points now. At these red points, you essentially do not have a trade even though you were allowed to trade, because exactly the market price is within this not trade region where not trade occurs. There are some moments when the external market price is outside of this not trade region, and if you were allowed to trade, you would have gotten a trade, but you were not allowed in some of these cases. In the green ones, as you see, the external market price is outside the not trade region, so an arbitrageur would be able to profitably trade with the pool. And this is actually what happens because they are allowed to trade at this moment. It is the moment that a block arrives. And so in particular, what the effect of this trade is going to be, as you can see here, is that the pool price does not go all the way up to the external market price in the first green X case, and it doesn't go all the way down to the external market price in the second green X case. There is essentially a suppression of moves in the pool price. And this happens because essentially the marginal profit of the arbitrageur has to be positive or zero for them to transact with the pool. And what they're paying, which is their marginal cost, which is the fee of the pool, essentially has to be lower than what they gain, the marginal revenue. So essentially the price, the AMM pool price, does not go all the way up to the external market price. So that's going to be the effect of both of these aspects. And now let's see what is the model that you would expect given what I showed you. Well, we still have the price model as previously in a Brownian motion, essentially. And we have two additional characteristics. First of all, we have discrete block arrival times according to a Poisson process. That is also the standard process in quantitative finance, and it is what allows us actually to get analytical results in this work. And so in particular, this means that on average, every delta t, you're going to see a block on chain. And we also have uniform proportional fees. So this means that you have a gamma fraction of the trade size that is going to be given back to the pool in the form of fees. For example, you can imagine a Uniswap 30 basis points fee. Let's also introduce some additional notation to see what the actual formal is going to be. So we have the PT, as we said, the external market price, and now we also have PT tilde, which is the implied pool price. So this is the price that you see in the pool. And we define a quantity that we call the log mispricing that essentially captures the mismatch between the pool price and the external market price. So this mispricing, ZT, is going to be a random variable that is going to be 0 exactly when the pool price is exactly the same as the external market price. So large mispricing means that there is a high mismatch between the pool price and the external market price at this time instant. And small mispricing in absolute value means that there is good price match between the external market price and the pool price. So let's, the bottom picture here is the picture I showed you previously. So this is how the price of the AMM is affected when you have these specific block times. And the top price is actually where we're going to see what happens with the mispricing now. So the mispricing, as you see, it oscillates around the interval from minus gamma to plus gamma. And actually, the profitable case, the profitable trades, are only going to be outside of this not trade region. So the not trade region is now captured in this interval, minus gamma gamma. Whenever the mispricing is within this interval, even if you're allowed to trade, you will not trade. And if it's outside of this not trade interval, then a trade will actually occur. And so what we will actually see over there is that in these green cases, we have a jump of the mispricing process. How is this jump reflected? This jump is reflected back to the boundary of this no trade interval. And the reason for that is something that has to do again with the marginal profit that the ARB is able to obtain. So the marginal profit that the ARB is going to obtain is actually only going to be non-negative whenever they're able to obtain a marginal revenue that's more than their marginal cost, and their marginal cost is the fee that they pay, this gamma, right? So this means in order for the marginal revenue to be greater than gamma, the mispricing has to be more than gamma in absolute value. So this is exactly why we see these trades and these jumps. And so this is essentially stating whatever I said to you previously a bit more formally. Whenever you get a block, you will get an ARB trade only if the mispricing is outside of this not trade interval. And how will you see this trade? You will see that the mispricing will get pushed back to the boundary of that interval. Otherwise, this mispricing is going to follow a diffusion process, so it's going to have some drift and it's going to have some Brownian component with the asset volatility. Now, in this talk, I'm going to make the assumption that the drift cancels out, but feel free to check the paper for the general version that holds for any drift. So the first result of our work is essentially the steady state distribution of this mispricing random process. And in particular, it's going to look like it will be uniform in between the not trade interval. So from minus gamma to gamma, it's going to look like a uniform density. And it's going to have exponentially dropping tails outside of this interval. In particular, I think a corollary that's interesting from our work is that you can actually think about the fraction of blocks that you expect to see with an arbitrage trade. And in particular, this is quantified by this quantity that I told you before, the P trade, which amounts to 1 over 1 plus eta, where this eta captures essentially how wide the fee band is compared to the typical price movement in the return space that you're going to see over half of the block time. So in the geometric burn-in motion model, this typical price movement over half of the block time is going to be sigma root of half of delta t. So this eta essentially captures how many blocks you're expecting to see until the typical price movement exceeds the not trade range, essentially. That's the intuitive explanation for that. And so, for example, if we have a daily asset volatility of about 5% and a 12-second block time, then we can see that the fraction of blocks that you expect to see an arbitrage trade ranges all the way from 4% to 81% for natural fees that we see on pools. So let's now talk about the arbitrage profits. That's the rather interesting case here. What we're going to do is, first of all, we're going to sum all of the arbitrage profits that we see over a time interval. Then we're going to take the time average of that, and we're going to translate that into an instantaneous rate that we see the ARB profits. And the result of our work is that in the asymptotically fast block regime, so as the block time tends to 0, then essentially what you're going to have the arbitrage for the arbitrage profits is that you're going to have all of these colored boxes that you see over there. The first two ones that you see match the ones on lever for small fees. And so essentially you're going to have arbitrage profits that are effectively lever times this new quantity that we saw before, the probability of trade. So these are the arbitrage profits that we're actually expecting to see on-chain. Now, what is the relation of that with the block time? Well, as we saw a couple of slides ago, the probability of trade essentially scales down with the square root of the block time. And the arbitrage profits are effectively lever times this probability of trade. So these two facts translate to the fact that arbitrage profits are actually going to go down with the square root of the block time. And so this means that if you have faster blocks, then liquidity providers are going to suffer less losses due to arbitrage. But of course, faster block times have other considerations that are outside of our model. For example, decentralization considerations. And as an example here, we can see that if someone manages to drop the block time from 12 seconds all the way down to 3 seconds, then the arbitrage profits are effectively going to be reduced to about half of what they were previously. we can do an analogous procedure to examine the fees of the arbitrageurs. And I will not go too much into the details of that, but essentially what this says is that we have the interesting result that the fees that the arbs are going to send back to the liquidity providers in the pool is effectively going to be lever times 1 minus P trade. So this means essentially that the arbitrage fees that you're going to get are going to be the difference between lever and the arbitrage profits because of the result that we saw previously. And so in particular, I think what I want to highlight here is that lever is still a very meaningful quantity that essentially is being split when you have trading fees into 2 sub-quantities. One that is essentially the profits that are earned by the arbitrageurs, and a second one that is the fees that are being paid back to the LPs. What determines this split is exactly this probability of trade. And so in particular, the arb profits are going to be the lever times the probability of trade. And what's left of that is going to be go back as fees. I think the one more interesting thing and one innovation in this paper that might not be apparent at first sight is essentially the use of Poisson arrivals that allow us to get analytical results in this model. That same technique essentially can be applied to other fee structures as well that have been proposed, for example, to mitigate lever. And so I think I would be pretty excited to see what the community comes up with to take advantage of these tools that we developed. And so with that, I'd like to thank you very much.
We have time for a couple questions, so people who want to ask questions can come line up in front of the 2 mics there and there. I have a first question, which is, I think what you call ARB in this paper is what most of the industry calls lever, and has adopted this term that you used last year to refer to this practical problem of reducing the actual losses by liquidity providers. But you're defining this new term, ARB, to describe that. Why don't you just redefine lever to apply to the no fee situation as well, or the positive fee situation as well?
Yeah, that is a great question. Actually, I believe that what lever captures is actually if you want, the money that is on the table. And so basically, lever is the total money that is on the table, and this money may go to several different paths.
So while you're talking, let him set up his computer.
Yeah. And so essentially, this lever can essentially go either to the arbitrageurs, it can go back to the liquidity providers, or it can go to block proposers. But it doesn't essentially matter where it goes to. The total amount that is on the table is still going to be lever. It's just that the split is going to be different. But it is true that the arbitrage profits are not going to be exactly levered this time because the split is defined differently.
Hi. I think it's a really cool model. You've managed to encapsulate the fact that you have 2 groups, both of which are providing services to the AMM. The LPs are providing liquidity so that there's enough there to do trades, and the arbitrageurs are providing the price tracking with the external price. And the profits from that, or are getting distributed between the 2 camps, and that can be calibrated by the fee and by the block arrival time, I suppose. It'd be interesting to see a follow-up model where you consider from the perspective of a user of an AMM who's trying to place an order into the AMM, and their relative preferences for liquidity versus price tracking. And based on that economic model, what would be the correct fee structure to set up within that AMM, right? Yeah, I think that would be a cool follow-up.
Yeah, I agree with what you said. I think though that we can't exactly determine what's the optimal fee structure. What we can rather do is compare a bunch of different fee structures. And I think this work gives you the tools to do that comparison. And I think the side from what you were mentioning is essentially the user's execution price, right? So what is the execution of the user? Is it a good execution or is it a bad execution that they're getting? This has to do with both price discovery and fees, and I think it's something that's usually called the effective spread. So that's essentially what the user effectively sees, because the user sees both the mispricing of the pool, but they also see the fee that they're going to incur from their trade. So these two might be in the same direction, or they might be in the opposite direction, and this affects how good the execution is of the trade.
Well, I think you probably could model it, right? Because you could probably construct some sort of utility function that balances between the liquidity present in the pool versus the spread, right, from the external price. And the user, the model user could to determine which one he values more relative to the other. And based on that, as the designer of the AMM marketplace, you could say, all right, I'm going to calibrate my fee to be this much, so not 30 beeps, but maybe 40 beeps or something, because that achieves something that is more desirable to a user with this kind of utility function, right?
Yeah, absolutely. If you don't have a specific utility function for the user, then yeah, you can get these sorts of results. Yeah.
Thank you.
Great. Thanks, Jason. Next up, Mahak Goyal from Stanford is going to be presenting on finding the right curve in his model for optimal design of constant function market makers.
Hello everyone, my name is Mohak Goyal. I'm a PhD student at Stanford University. I will present my work with my collaborators Jeff Ramseyer, Ashish Goyal, and David Maziers, who are all also at Stanford University. So this work is on the design of the constant function market makers, that is the trading function which the LPs want to use for the market making. So many of you would be familiar with the basics of market making, but I will still go over some of the basics. So market makers are the traders who are willing to take both the buy and the sell side in any pair of assets. And by doing so, they provide a liquidity to the market. In this business, they take a risk of ending up holding an asset whose price may decrease in the future. And in return for this risk, they earn a bid-ask spread or a fees on every trade that they facilitate. In traditional finance, market making is typically done by high-frequency trading firms. These firms have complicated inventory management and pricing algorithms. They look for new information and incorporate that in real time. By real time, I mean in the order of microseconds. And they keep their strategies and information privately, and that is their edge over the competitors. Now, in the new era of decentralized finance, we want to do market making on public blockchains. However, the blockchain infrastructure is not well suited for the traditional type of market making. For example, in the current state of the blockchains, there is high latency, low throughput, and high gas cost, and there are problems such as front running. Also, the traders' strategies have to be transparent, which removes their edge over the competitors. However, there are still billions of US dollars engaged in decentralized finance today. So how is this happening? So one innovation which has driven a lot of the progress in decentralized finance is constant function market makers. So this is a market making strategy which is intuitively very simple. That is, liquidity providers can deposit their tokens in a shared pool and define a simple function for computing the price that they want to offer for any trade request. So the trading function has to be quasi-concave, continuous, and non-decreasing in the asset amounts. The trading rule specified by the trading function is that any trade is acceptable as long as after the trade, the CFMM's trade function value is not decreasing. So this is the entire set of requirements that the LPs have to satisfy to set up a CFMM. But the question is that which CFMM should a liquidity provider use? So let us consider a simple example. We want to make a market between the euro and the US dollars or their crypto equivalents. The liquidity provider has many options. One canonical choice which has been very successful and popular in the initial days of DeFi was the constant product market maker. Informally, the constant product market maker will spread the liquidity to all the price points possible. However, an LP may feel that the price between the euro and the US dollar may not change in the near future, and the most efficient way of depositing their liquidity is to put it at one price point. Another possibility would be to spread the liquidity to a smaller price interval, and there can be an infinite number of such possibilities by taking interpolations of these curves. So before designing the curve that a liquidity provider may want to use, we first want to understand what are their sources of revenues and the losses. Their main source of revenue are the fees that they charge on each trade, which is equivalent to a bid-ask spread. However, they also have many losses. One important source of loss is the inventory cost. This is basically the loss that they have to face if the assets that they hold for market making diminish in price relative to a numeraire. This loss can be hedged partially by buying options as shown in previous work. However, the more important part of their loss is the loss due to the arbitrage, which is captured very well in the Lever metric. So this happens when the asset's fundamental value changes on an external exchange. However, since the CFMM is a passive trading strategy, it continues to trade at a stale price unless an arbitrager comes along and they correct the CFMM's price. By doing so, they make a risk-free profit. And as shown by previous work, this loss is unavoidable. We can reduce it by choosing better trading strategies, but we cannot totally eliminate it. So these are the major considerations that an LP must have before deciding whether they want to enter the business of market making, and if yes, then with which trading function. So I would like to summarize our contributions on this slide. So we give a framework to find the optimal CFMM trading function, which is optimal in expectation for any given set of beliefs on the future prices of the underlying assets. Or they can also work with a price dynamics process, and they can use their dynamics process to condense that into a set of beliefs on the future prices. And our framework can consider different objectives, which can include efficiency. We define efficiency as the fraction of trades that the CFMM can satisfy within a maximum slippage amount. We can also consider the fees and the different types of losses. Our framework is also able to explain some folklore intuitions of CFMM designs which have been successful in practice. One important thing that I want to clarify is that in this model, we do not consider rebalancing. Our results basically apply to the interval between two subsequent rebalancing events. So this is very broadly put, our optimization problem will look something like this, that we want to maximize some objective function, which could be a combination of efficiency, loss, or whatever the LP is interested in. But their constraints are very specific to the CFMM's design principles. So first thing is that the LP will start with a limited total budget. This can be easily encoded as a linear constraint. We have a budget of $B, the price of X in the external market is PX, and the price of Y is PY. And we can buy any combination of these as long as it fits within our budget. Now, the next question is, how do we encode the quasi-concavity of the trading function as a constraint which is amenable to our optimization problem? So for this, we will go to another view of a CFMM trading function. We first define a spot price as the price offered for an infinitesimal trade. Then we can see that we can write the reserve amount X and Y in the pool as a function of the price that it is offering, that is the spot price that it is offering. And given any spot price P, we can define the liquidity at that spot price as dy over d log P. So basically, informally, what the liquidity is that the amount of Y in the pool which is available for market making when the price, the log of the price changes by a small amount around point P. I want to point out that this exact definition is not crucial for the results to hold. For example, we could have used dy over dp, or we could have used dx over dp, or something like that. The expressions would look different, but the core results will still hold. So coming back to our optimization problem, the quasi-concavity of the trading function can simply be encoded as non-negativity of the liquidity. So this introduces an infinite number of decision variables to our problem. That is, there is a decision variable, the liquidity at price point P, for every positive price. The liquidity being non-negative implies that the level sets of the trading function are convex. Now we come to the next constraint, that is the amount of y should not be negative. So to go about defining this constraint as a function of the liquidity, we first want to use the fact that the CFMM is a path-independent trading strategy. So we take a price process, assuming that the price continuously decreases from the initial price P0 and goes up to 0. In this case, the CFMM will sell all of the Y that it holds. So this case will give us the condition that the CFMM should not be able to sell more Y than it started with. So if we integrate LP over P over the price interval 0 to P0, then this exactly gives the amount of Y that the CFMM will sell. And we can see that this encodes the non-negativity of Y as a function of the liquidity of the CFMM pool. The next constraint is that the amount of X should not be negative. And for that, we take the other sort of price movement in which the price increases from P0 and goes all the way up to infinity. In this case, the CFMM will end up selling all of the X that it holds. And by integrating LP over P square from price P0 to infinity, we can encode the constraint that the CFMM should not be able to sell more X than it started with. I want to point out that there is a bit of difference between these two expressions. In the first expression, we are integrating LP over P, and the other we are integrating LP over P square. This is just an artifact of the. This is just because we define the liquidity in terms of Y and not in terms of X. So it's actually the same thing. Now we come to the next important thing, that what is the objective function? For defining the objective function, we need a model of the trades that happen on the CFMM. So this is our trade model. We first assume that there exists a common knowledge true price of X and Y, or let us say the price of X in terms of Y, which we denote by P. And we assume that there are two types of trades. One are the arbitrage trades, which correct the price on the CFMM, and the other are regular trades, which may be done for intrinsic reasons for the traders. We define a trade success such that a trade buying X with a maximum slippage epsilon and price P succeeds if the CFMM can offer a price P prime at most 1 plus epsilon times P. An equivalent definition can be given for trades selling X. We assume in this work that all regular trades have the same maximum slippage epsilon. This assumption is just to make the analysis a little bit easier. We also assume that the regular trades for buying versus selling X are balanced in expectation. That is, apart from the arbitrage trades, the regular traders do not in net accumulate a position in X or Y. So with this trade model, this model may not be perfect, but it captures important insights, and this will give us a lot of insight into the results as well. So one important metric that we want to capture is the rate of the trades that can be successfully fulfilled by the CFMM. Intuitively, we can think that higher liquidity at a price point would ensure that more trades would go through. By trade failure, I mean a trade is failing if the slippage offered is more than epsilon. So we have a theorem that for balanced trade patterns, that is when the amount of X and Y, the amount of X bought versus sold is balanced. And for small trades of size K, the trades have to be small with respect to the size of the pool. At a price P, the probability of the trade failure is approximately K over 2 times log 1 plus epsilon times LP. So the probability that a trade fails increases with the size of the trade, which is what we would expect. And the probability of a trade failure decreases with the slippage that the trader is willing to accept. Also, the probability of trade failure decreases with the liquidity at the price point. The proof of this theorem is based on the stationary distribution of the CFMM state when it reaches the price P. The important takeaway from this result is that the trade failure rate is a convex function of the liquidity at each price point. Now, using the results from the trade failure rate, we can define the trading fees that is collected by the CFMM. So the CFMM naturally collects fees on the trades that succeed. Let us say the rate of trade arrivals of unit-sized trades is R of P. So there is an assumption hidden here. We assume that the rate of trade arrivals is independent of the liquidity, which may not be the best assumption, but in this framework we can also take rates which increase with the liquidity, but they have to be concave and slowly increasing for this framework to work. For simplicity of presentation, I'm assuming that the rate is independent of the liquidity. The fees per unit is gamma, and the rate of fees collection is given by this expression, gamma R times the probability of trade succeeding. The important takeaway from this slide is that the revenue is a concave function of liquidity at each price. And we would like to maximize the revenue, and maximizing concave functions is easy. Now comes another important ingredient in our framework, which is CFMM's loss. So the instantaneous LVR is defined as the volatility of the price pair, the price in the asset pair, times P square times dx over dP. So by simple algebraic computation, we can see that negative of P square dx over dP is exactly LP as we defined it before. So the instantaneous LVR is sigma square LP. The total LVR is computed by integrating the instantaneous LVR over a period of time. So we can use our definition of liquidity in that expression. Another important metric is the divergence loss. For the divergence loss, we want to define a final price when the liquidity provider liquidates their position. Let us say that price is Px and Py, and P hat is the ratio. The value of the pool at this point is Px times the amount of X that the pool holds, plus Py times the amount of Y that the pool holds. We can write this expression also in terms of the liquidity, and it is given by this expression above. So while defining the constraints, we saw how the amount of X in the pool can be given as an integration of the liquidity from a given price up to infinity, and the amount of Y in the pool can be given as an integration from price 0 to P hat. The divergence loss is simply the final value of the pool minus the initial value of the pool. So in this case, this is V minus B, and B is the amount of dollars that the liquidity provider invested. So the important takeaway is that both the LVR and the divergence loss are linear in the liquidity at each price. Now, what objective should we choose? So we do not answer that question, what is the best objective to choose. We give an optimization framework, and the liquidity provider can choose their own objective function, which could be linear combinations of the expected fees revenue, or the efficiency, or the expected cost. And all of these natural objective functions become combinations of LP and 1 over LP. Now, the next important question in our framework is that what is this expectation that we are taking over? For that, we need to assume that the liquidity provider has some model for the price movements of the underlying assets relative to a numeraire. This model of price movements will induce at a given future point of time a joint distribution on the prices of X and Y. However, a liquidity provider will not make a market at a single point of time in the future. They will want to take an integration over the entire time duration in which they are entering the LP position. So for this, we again take advantage of the fact that CFMMs are path independent, and we can easily integrate over the price that is going to be realized in the future. And the expectation over a time horizon is equivalent to a different joint distribution. So for deriving this sort of a belief function, I take the example of the Black-Scholes model. Let us say an LP wants to use a curve for time is equal to time 0 to capital T, and they assume that the prices of X and Y will independently follow a geometric Brownian motion. The variances in the prices will be sigma X and sigma Y, and the drifts may be mu X and mu Y. The rate of time discounting is lambda. By linearity of expectation, the LP can collapse the entire price dynamics into one single prior function. So they can take the integration from time t is equal to 0 to capital T with time discounting. They can take the priors on each time in the future, and they can find the belief function that they're going to use in the optimization framework. So now, coming back, now plugging everything together, let's say we take an example of maximizing the net profit. The objective function will look like something like the expected fees that is collected minus the loss. I'm omitting the expression for the loss here because it will be too cumbersome to parse, but it is linear in LP as we saw earlier. The interesting thing is that now this program is a convex program, and we have a decision variable LP for all real P. That is, we have an infinite number of decision variables, but thankfully we can handle that analytically. The constraints are linear in LP, and the objective is the maximization of a concave program. Now, from convex optimization theory, we can see that the KKT conditions often reveal important things about the problem itself. In our problem as well, the KKT conditions are analytically tractable, and they give a closed form map from the choice of trading function to the joint distributions that give the belief of the liquidity provider. So this can help us understand what people are doing in practice. So one canonical choice of the trading function is the constant product CFMM, which was used, for example, by Uniswap v2. If maximizing the fees revenue without accounting for the loss, and if the prices of X and Y are thought to be independent and uniformly distributed on a unit square, then the constant product CFMM is the optimal choice. So this is informally like a one-size-fits-all CFMM. We can take a few more examples. So if the LP believes that, for balancer, let us say if the LP believes that X is going to be more valuable in the future than Y, then they will choose a value of alpha greater than 1. And the balancer CFMM is actually the optimal choice for them. If the LP believes that the price of X and Y are more likely to be similar to each other rather than independent, then the CFMM implied by the LMSR rule would be optimal for them. So I would like to summarize that in this work, we provide a framework for potential liquidity providers to decide which CFMM, if any, is going to be the best choice for them for the market making. And this framework also explains some of the intuitions behind the widely used CFMM trading functions. Thank you so much.
I want to ask about the practical implications, and maybe taking a specific example. You mentioned, so if you go back to the slide, oh, wait, so you're on the computer. The slide with the LMSR. So you're saying LMSR is a good fit if the expectation is that the prices of, say, like a yes and a no share traded against each other are going to be similar?
Yeah.
So usually if LMSR is used for prediction markets, I think like the one thing we know about prediction markets generally is actually that they're going to resolve to one being worth the price of one and one being worth the price of zero. In a lot of cases, I think prediction markets tend, at the end of their lives, to actually go toward one of those prices. So why would LMSR be a good fit for prediction markets if that's the belief function?
Yeah, that's a good question, and I'm not entirely sure about this. Yeah.
Sure. Yeah, Alex.
I wasn't sure what exactly, what assumption you make about the fees in this model. So do arbitrageurs pay fees or do they not? Because if they don't pay fees, then basically LPs cannot capture any value from the uninformed flow. If there's an uninformed transaction, it pushes the price somewhere, and then arbitrageurs will kind of backrun it, and get the full profit. And so LPs don't get anything. But then,
Yeah, thank you. So in this work, we assume that the bulk of the trading volume is going to be from uninformed traders. So for the fees, we only capture for the expression of the fees, we only capture that part of the fees. And for the fees that is coming from the arbitrages, that we omit here, but I agree with you that that's also an important thing to capture.
yes, I think it would be great if you could charge a different fee to the two different flows, right, to arbitrageurs. But I'm not sure that we know enough about how to do it. And then another thing that I just want to point out quickly is that in the previous paper that we saw today, there is a result saying that the loss depends on the liquidity that is available sort of on the margin, but the shape doesn't actually matter that much. If I read it correctly, I don't want to misrepresent what the paper is saying. So when you take fees into account, I wonder if the results will eventually, the shape is going to matter as much as it does in the current setup where the fees are symmetric. But I guess it's a topic for future research.
Yeah, so these two models are kind of incomparable in that sense. So we assume here that the arbitrageurs can exactly correct the price of the CSMM. We do not have that no trade region in this model where the arbitrageurs will have no incentive to trade. So yeah, that's an interesting thing for an extension of this work. Thank you.
Thanks, Mahak. Is Joseph Poon here? Joseph Poon is here. Hello. What's that? Yes. All right. So next up, we will give you a computer. The slides. We've got the slides. Okay. Yeah. So next up, we will have Joseph Poon and Chris Jeffrey. So Joseph is one of the co-creators of both Lightning and Plasma, and this is the first time that they are presenting publicly Warp, an algorithm, or a what is it?
It's
A decentralized exchange, efficient decentralized exchange algorithm.
Yeah, awesome. You got to look out. Hi, everyone. We're here to present an on-chain matching engine, and there's been no method in the blockchain to directly match buyers and sellers completely on-chain without capital-efficient liquidity pools with high price precision. And we needed this for an on-chain matching engine in order to make a decentralized cross-chain wrapping system for UTXO assets. That's not what we're presenting here today, but it's, I think the need in this space for a direct matching engine on-chain that supports things like the EVM to be critical in this space. And we think there's a broad applicability, and there are, in our construction has gas cost comparable with AMMs on the EVM. So I think it's important to go through what we're talking about through the historical narrative, because I think that'll inform what we're trying to solve, and also hopefully it gives some intuitions when we sort of present the solution, and maybe it's sort of like directionally as we explain the history, you can sort of see directionally where we're headed anyway. Now, there's in a normal centralized exchange, equities markets, whatever it may be, you're going to have these things called order books, and if you wanted to, let's say, buy 18 bags of apples, we all could see what should happen, right? You go to Wally, you fill his availability, and then you fill at 11 partially, right? That's easy to see for us, but there's actually not an easy algorithm to do this on-chain because of gas constraints. Because imagine if instead of a single order, sell order at $10, imagine if there's hundreds of these at hundreds of prices, like $10.01, $10.02. You're now doing read records on hundreds and hundreds of orders potentially at different prices, at different price levels, and at different price individually, all the way up to $11. It could be like hundreds or even thousands, right? And on the blockchain, you need constraints, capacity constraints. Otherwise, there's denial of service attacks. And that creates significant issues. So this gas limit problem is fundamental to what we're going to be looking at. So what are some early approaches? EtherDelta, they traded off price-time priority. And price-time priority means if you put in an order at a higher price, you get filled first. If you put in an order later than someone else, you're going to get filled later than them. EtherDelta was just, it's sort of like Craigslist or Facebook Marketplace. You throw the orders out there, it sort of goes, and then who knows what you're getting kind of thing in terms of who's getting it and in what order. And then there was a way to sort of abstract that complexity, that linear complexity away by running a central server. Now you are trusting the central server for matching. Who knows what they're doing? But the general idea is that there's some centralized point of trust on the matching itself. Now, you're not giving custody to them, but there is this process of that. And to this day, today, you sort of see this in the RFQ constructs. And what we think is very clever was the Gnosis Dutch auction. The Dutch auction construction was, there was a time decay. And if you fill it earlier, you pay a higher price, or a higher price gets set. The trade-off is, to do price discovery along something granular, it's probably going to take, maybe potentially days or weeks in order to do price discovery. But it is fully on-chain, and it is a way to do an auction system. So AMMs. Now, I'm sure most of us are familiar with AMMs, but I think what we want to point out here is that the kernel of AMMs is that you're providing a single price. By aggregating your orders together into a single liquidity provider, this problem that we had with these many different orders, well, you're just dealing with one guy, one record on chain. And you only need to fill one price. The trade-off, as we know, there's high capital requirements, and you put in a lot of money, there's impermanent loss. Concentrated liquidity, adjusting the curve definitely helps significantly with that. But it doesn't eliminate the problem space. You still need to be supplying, $1,000 of X and $1,000 of Y to do these LP constructions. And auctions are very challenging, and auctions are necessary in order to do decentralized, fully decentralized oracles without, validators and trusted counterparties for crypto assets. And it'll continue to be useful and superior for certain applications, but we're strictly looking at, an order matching type of DEX problem here. What do we have today? So today, in terms of if you want to do tight prices in DeFi, you have RFQs. You're essentially trusting some RFQ server to do this matching, and they're not really doing matching, they're more doing quotations, but it's the same general idea. They give you a price, you execute on it. If you choose to, you broadcast it on chain, people deliver prices to the RFQs. So there's some issues here with RFQs. It's a trusted intermediary. A sizable proportion of DeFi is now becoming RFQs. You give it a couple more years at the current trajectory, they're going to dominate, right? Like they just have the tightest spreads compared to other things on chain right now. Because they don't have to deal with these fee constructions and these other things, they're able to do it, right? And you have basically what amounts to be black box, centralized, opaque providers. And to give you a color on what we're talking about here, some RFQ providers in their docs, this is publicly disclosed, tell you that if you are supplying liquidity on RFQs, you can differentiate your users based on what website they're using. So if you go to an RFQ and get a quotation from website A, you can give them a different price than if they went to you on website B. So it's already self-selective and not an open market. But we think there's an opportunity here. I think the landscape has changed for on-chain matching. We now have smart contract L2s where we didn't before. Capacity has ballooned. There's so many L1s and L2s where we're only using maybe 1% of the available capacity, maybe less. And with more engineering, more work that everyone in this audience is participating in, or many of us, that I think capacity is going to increase even more with these rollups and ZK constructions and everything in the future. And I think we have sufficiently fast block times to start working on matching engines. And I think there's a lot of cool continued innovations ahead. So our contribution that we're presenting today is about a logarithmic matching engine. And it's important to find the problem of what we're looking at here, because I think when you see the problem, you can start to see where the solutions lie, right? The problem is fundamentally that you are filling many different prices, and that's a linear complexity problem. There could be thousands of orders with very, very small orders, because we're doing things on chain and we're dealing with an adversarial setting. Someone could fill, anywhere from, you want to fill from $10 to $11, there could be thousands of prices in there. So you could trade that off with precision, right? So you could say, okay, we've got an order book, we only have 10 different prices, maybe, and we only allow a certain amount of orders. Yeah, you could solve the problem that way, but that's not the experience that you have with traditional exchanges. That's not what people expect, and that's not a true matching engine at that point. So we constructed an EVM-optimized radix tree data structure compatible with the EVM. The EVM has incredible constraints. 32-byte keys, 32-byte values. Fitting everything in 32-byte values is not easy, and fitting the data structure in which minimizes reads and writes is highly complex. You know, like intermediate nodes, and here's the other insight, which is intermediate nodes, which JJ will be getting into soon, is they're going to contain both the child node's values and quantities. And that allows for true limit order books, auctions, and et cetera on-chain, where all the executions happen inside the smart contract, all the matching happens inside the smart contract, and all the storage is in the smart contract. There are no validators, there's no cranks, it's happening on-chain. You know, like the person that deployed the contract can walk away, shut off all their computers, it runs. It does its thing. We're talking about extremely high price precision. And this is the important point, because price precision is the problem that is being solved. You know, you can abstract it away with low precision. But if you want 1/10 of a basis points, that's a much bigger challenge. And that's sort of what people use in the Forex market. This is the standard. And we have a construction which is fully time-bound in the worst case at several 100,000 gas. It's very efficient, usually less than 200,000 gas. The worst case should never happen. We're talking about, potentially trillions of orders or billions of orders that persist over many years that never get filled. It should never happen. But in the average realistic case, we're looking at below 200,000 gas. It's comparable to AMMs. Most popular AMMs are around 150 to 200. You know, some do a little bit lower, but it's somewhere in that range. We have an implementation in both Solidity Assembly and coming with C, which should be WASM capable.
Okay, so I'd like to quickly go over the problem. So the problem, as Joseph mentioned, is there's a lot of linear complexity going on in order books and matching engines. So problem, many orders can be placed at the same price, and one order may potentially fill an infinite number of orders or prices. And linear complexity in a decentralized system where n is unbounded is absolutely unacceptable. You can't do that on a blockchain. So the most well-known matching engines, at least the public ones, don't attempt to even address this problem. So our basic approach is to decouple matching and execution. And historically, these were considered the same thing. Matching and execution would happen at the same time. But by doing this, we can have synchronous matching and asynchronous execution. I'm going to explain what that means later. But this means that we can have log-n matching. But first, I'm going to go over some of the traditional data structures that are usually used for order books and matching engines. So typically, the most traditional design that we could find, there's actually very little literature on this subject. A lot of these matching engines are trade secrets from centralized exchanges and whatnot. So, but the most traditional design is you use a self-balancing binary search tree or a radix tree. And the nodes are prices. And in each node, you have a linked list of orders. So like it has some decent properties, right? You have log-n insertion, and you can optimize this and have O1 insertion if price already exists. You have O1 cancel, price lookup. But the big problem is like you have ON matching complexity. So this design first reached a wide audience as the result of now a frequently referenced blog post from 2011. It's like if you search Stack Overflow, if you search Google, like how do I write an order book, everybody references this blog post, which uses this design, which basically looks like this. So you have a tree, and each node in the tree is a price. And they point to within each node is a linked list of orders. A doubly linked list, right? So you get O1 insertion, O1 removal. But the problem is if you try to match, right? You have to iterate down this tree, iterate through these linked lists, go through every order and every price that the order satisfies. So you have this crazy complexity all over the place. And this is why this cannot be used on a decentralized system. So the other approach, which came around the same time was the QuantCup approach. And around the same time, there was what was called the QuantCup.org contest, which was a contest to see who could write the fastest matching engine in C. And this was a minor improvement over the tree-based approach because it utilized a pre-allocated array of price points. So that's a little bit better than a tree because you get better caching properties, right? Because you're not chasing pointers all around this tree. You always have O1 insertion because you're always just going directly to a price bucket, which has a doubly linked list. But again, the problem is you have ON matching complexity. You have OM space complexity, where M is the number of prices. You have to pre-allocate this giant array. And there's a lot of limitations there. But it won the QuantCup.org contest, so this is another frequently cited design. And basically looks like this. So it's very similar, except that top row is an array. And each item there is a bucket in an array, which points to a linked list of orders. So it looks very similar to what we saw before. So our approach is a little bit different. I'm going to be showing you an example of our tree. In reality, we use a base 2 radix tree. But for simplicity's sake, I'm going to make it a base 10 tree so that's more understandable for everyone here. So the idea is you utilize a radix tree of prices and orders. So everything is the same thing, basically. So we have a decrementing, so we have a price. When you insert an order, you have a price. And we have a decrementing counter, which creates a decremented nonce. And you append that nonce to the price to create a path down the tree for insertion. And that's basically how you insert into this radix tree. That's what the path is. The idea for the decrementing nonce is you obviously want it to be higher for earlier orders to maintain price time priority, because you want earlier orders to go on the right side of the tree, because as you'll see, we're always going to be matching from the right. So like Joseph mentioned a little bit, so leaf nodes maintain 2 extra fields, quantity and value. Okay, so I'm going to need to define some things. So like quantity is so we have an ETH USD pair. Quantity is the left-hand side of the pair, or the base in quote, right? That's probably what a lot of people are familiar with. I'm going to say left-hand side, right-hand side, because I find it more understandable. So we have quantity, which is left-hand side of the pair, ETH, and price, which is the right-hand side of the pair, USD, and value, which is price times quantity, and the result is in USD. So internal nodes maintain some quantity and some value, where each of those fields are the sums of their children's respective values, right? So this tree basically has O log n for every operation, including matching. And execution is decoupled from matching. So execution is offloaded onto the traders themselves. And I'll maybe explain more of that later. But now I'm going to go through what an insertion into this tree looks like. Bear with me because these slides can get a little bit complicated. Okay, so we have an ETH USD pair. We want to insert a bid for 1 ETH at $17.99. That's our root. So we have a counter, which decrements. We append it to the price, so we have 1799:9. That's our root. So our path is 1799:9. Our quantity is 1 ETH, and our value is 1799 because obviously 1 times 1799 is 1799. So what happens when we insert again? New bid comes in. Oh, also, sorry. Assume that the this is a bid tree. Assume that the ask tree is empty. Because these trees, when these orders comes in, they sort of like eat away at the opposite tree. But right now we're assuming that the ask tree is completely empty and there's only bids coming into the order book. So we insert another bid, 0.5 ETH at 1800. So there's a collision here, right? They both start with a 1 digit, so there's a split that happens. And now our root node has a prefix digit of 1. And the new bid that came in has a higher price. The nonce doesn't really matter right now, so it goes on the right. I'm sure you're all familiar with radix trees. The only big difference here is everything is getting summed up. All these quantities and values are getting summed up. And you can see the rightmost leaf has quantity of 0.5 ETH, value of $900 because the price is $1,800. So insert again, same thing, counter decrements. this goes on the left. It's a low price. Insert again. So what we're doing is we're building a tree so we can match against it, right? So we insert again. Again, all the sums still apply. We go down the right side this time. It's a high price. Everything gets summed up to the root. We insert again. So this one's interesting, right? Because we go left, right, left. There's a split that happens, an internal node that's created. Because now there's two orders at the same price, right? So if you look at the bottom left green node, which is a leaf, 1799:5 next to 1799:9, right? The :9, that nonce makes it go on the right side of the tree. Remember, we're always going to be matching from the right. So because the order to the right of the green leaf came in first, it gets a higher nonce. So it's going to get matched first, even though they're at the same price. And same thing here, right? So a new node comes in, 2.5 ETH at 1802. And there's already an order at there's already a bid at 1802. But this one has a lower nonce, so it's going to get matched. It's going to get matched later, depending on what happens. So this is the final state of the tree, and now we're going to start inserting asks, and this is where the magic happens. This is where we're going to see the logarithmic behavior of our algorithm. Ask comes in for 4.2 ETH at $1,800. Now remember, we're always going to go right down this tree. So we go right, and then we hit the red node. And we notice that the red node, its path, not its price, its path, is higher than the asking price, right? So this entire subtree can satisfy this order. There may be 1 million orders, 1 million nodes underneath the red node, and we do not need to traverse them at all. All we need to do is delete that subtree and promote the left node. So we just technically matched. In this example, obviously, there's 2 orders there. There's 2 leaves. But pretend there were 1 million. We can match 1 million orders just by deleting that node. And then we tally up the value in an accumulator, the sum value, and then we sort of decrement the quantity that we're matching against. So this is what's going to happen. So the blue node gets promoted, and it takes that old internal node's place. We deleted the subtree in red, okay? So we didn't have to traverse either of the nodes under the red node. So once we promote this node, what happens is it's a partial fill. There's 0.3 ETH left over as a result of this order. Okay, so let's run through another ask again. And again, these slides take a while to grok, but I think you'll get it if you stick with me here. So another ask comes in. Again, we go right. This ask is for 1788 and a quantity of 4.55 ETH. We go right, we hit a leaf. We see that it's $1,800, so it's greater than the asking price, so it satisfies the ask. Again, we're going to promote the left node, so it looks like this. So we're promoting, blue node becomes the root, then we start going down the blue node again. Again, we're always going right. And this is what happens. So we go right again, we hit the right node, and we notice that the prefix digits 179 are greater than 178. So again, this entire subtree can just be deleted. And we can take the sum quantity and the sum value and tally them up. And then again, we promote the left node, and this is what we're left with. A partial fill, that's our root. That's the final state of the tree. Okay, so what's happening here? So the idea is that the seller's order is consuming as much as possible of the bid tree. And now the protocol knows exactly how much USD the seller gets and how much ETH they need to spend to get it. Any leftover ETH is going to go on the other side of the book. It's going to go into the ask tree as a resting order. So, and the ask tree is basically the inversion of the bid tree, right? It's the same exact behavior. It's just flipped. So now traders, like I said, there's asynchronous execution, right? So all we do is the matching. The traders actually need to execute their orders by claiming it. And the idea is they can go to claim their order, and you might be asking, well, how could they claim their order if it's deleted from the tree? And the idea is they have an ID for their order, which is the path down the tree, right? It's the price and the nonce and the side of the book, sort of. So what they can do is they can hit the contract and say, by the way, this contract basically only has two functions. It has order and cancel and claim are basically the same operation. So the idea is I want to claim my filled order. So what it does is it hits a separate storage record to make sure that order exists, and then it traverses down the tree. If the order is not present in the tree, that order is completely filled. If it is present in the tree, it's either partially filled or just not filled at all. It just like went on the book. And then they get whatever value was in there, and that would be a cancel, right? So claim and cancel are the exact same operation. So it's a very elegant system in that you only need two operations. You only need order and cancel. That's it. It's two operations. So like I said, our implementation on the EVM differs a lot from the examples I showed you. It's not base 10, it's base 2. Just because base 2 radix trees have a lot of nice properties. It's a lot easier to work with base 2 radix trees on the EVM because of all of the EVM's constraints. You know, you wouldn't want to use like some like base 16 radix tree or just, and also we were writing this in Yule, which is how we got it so highly gas optimized. So the idea with our EVM implementation is that we have a 24-bit price, 40-bit nonce. So that gives you 2 to the 24 different prices, and that gives you about 1 trillion orders that can exist in one pair. It's so high, you'll probably never hit it. In our randomized benchmarks, the median gas usage for placing a limit order is around 120K. But if we exclude orders that fill immediately, and we only include orders which hit both sides of the book, the median gas usage jumps up to about 150K. Claims and cancels can be batched. A cancel is normally around like, a claim or cancel is normally around like 70K gas. But if you batch them, and again, it depends on like the batch size. Like if you're, if you're batching like 100 orders, the median gas usage drops down to like 25K gas per order cancel. And the reason for this is like when you're getting like sort of like a slight gas refund by deleting stuff, and also like you're also hitting, you're repeatedly hitting like the same storage slots in the contract. So those are all hot. So it's like batching cancels can be very efficient. And to our knowledge, this is the first on-chain data structure which resolved a linear complexity problem, right? So this is the first truly logarithmic matching engine that can actually be used in a decentralized system, to our knowledge. So you might be wondering, you might be thinking, well, this is a radix tree. Eventually, it'll get fully saturated, right? And it'll have to do all these traversals just to get down all the price digits, and it'll have to do all this summing back up the tree when it inserts, and it'll have to reduce the sums when it matches, and so there's a possible optimization here that we're working on, and the idea is that the rightmost branch of the tree doesn't include its right node's sums. So the idea is that most often in an order book, people are placing orders near the top of the book, right? So that means they're always going to go on the right side of the tree. So if we exploit this fact, and we make it so that in the rightmost branch, the nodes don't include the sums of their right children, we can avoid all that summing during insertion and matching. And we believe, we don't have this optimization working quite yet, but we believe in the most typical case, the most typical orders could get around 100K gas usage, maybe even less than that. And Joseph, you take it from here.
Yeah. So like we are doing a high-level explanation. Like we said, like there's some changes with regards to how the radix tree is, like technically it's the two childs that are green, but it is what it is. So in terms of implications, we think it's useful for a wide range of DeFi applications, not just decentralized exchange. We need it as an auction scheme as well. An auction scheme is very interesting because, like think about the normal DeFi, a common DeFi use case of, some liquidation of some underlying asset, and normally they use some oracle and then they sell it on the pricing mechanism in order to do that distribution. That oracle can get manipulated, as we saw with Mango. Instead, in order to reduce the potential for manipulation, what you could do is this thing that's getting liquidated, you throw it into an auction, people bid on it, people can arbitrage it out with other exchanges, and that's a lot harder to manipulate because if you put in a low price, someone's going to put in a higher price, right? Like it's very hard to do right now to do an auction scheme of like a large asset with many different bidders with small amounts because functionally you need an order book. You need an on-chain order book. And I think it can provide, as a result, an alternative to the composability design pattern. And composability, oftentimes, you're hitting other contracts in order to fulfill whatever you're looking to do. And maybe you could just auction whatever it is that you need, and that you leave it up to market makers to do this composability functionality. AMMs inherently, due to impermanent loss, have some percentage costs. And they need to account for impermanent loss. We think that market makers basically are capturing the bid-ask spread under this construction, and maybe that can tighten the competitiveness in this space with regards to centralized exchanges, RFQs, and things like that. So what are the opportunities here? I think it brings about when you can do an on-chain order book. I think we can do a new round of L2 innovation, where if you think about it, with a lot of these roll-up constructions, the primary cost being borne is the cost of the data availability on the L1. So you take a transaction, you broadcast the call data on L1, or it gets bucketed together and broadcasted on L1. And that would likely require, but maybe instead, you flash the orders on the L2, and it's only when it matches, when an order gets filled or partially filled, that you even need to prove data availability. Because if an order gets issued and canceled on an L2, why do you really need to prove anything? Like no money has really changed hands. And that allows you to really reach scale where you can issue maybe like an incredible amount of orders per second, and a certain percentage gets filled, and those get committed on L1s. Now, this probably requires some opcodes and changes on the L2s, but it's theoretically possible, right? I think you could, because you could do commit reveal schemes, you could, commit to something and then say, okay, I actually did the order at this price and do it at a later date. I think it becomes interesting and necessary for these types of things. What I think is really promising with this is because we have bounded complexity. Specifically, it's a tree that has a depth of 64. All the other order matching algorithms out there that are published have linear complexity, i.e. infinite, basically, complexity, where, near infinite, where at each price you can fill each possible price. And that's a lot of possible different prices. How are you gonna unroll that loop, right? With this, you could have a 64 deep loop, you unroll it, and then you may be able to do interesting things like ZK constructions off of this to build a true central limit order book with a ZK construction. So I think, when we think about we're building, if we have an on-chain order book, if us as a community, if we have this as an algorithm, we could just broadcast an order. It hits a full node that either you run, at home or, in some data center, and you're doing the execution on your computer, or a computer that you authorize. You're doing the matching on your computer. You're doing all the data is on your computer. All the data gets broadcast everywhere together. That's very different than centralized exchanges, equities, like the New York Stock Exchange, NASDAQ. You're hitting some server. And this is a construction where you have everybody computing everything together. And I think that gives us an opportunity to explore new avenues and gives us the ability possibly to see, to show traditional markets what the opportunities are. So we have an EVM Solidity assembly version, also known as Yule. We're releasing around mid to late September 2023 in order to maybe see if the optimization is possible and also do some code review. Yeah, we're definitely looking for code and technical comment on this. Yeah, and we'd be honored to have your review on this. Yeah, thank you so much.
Thank you.
I have a couple questions if people want to line up at that mic and that mic over there. So I think it's very impressive what you've done to reduce the cost of execution, but if you still have the cost of placing orders and canceling orders and claiming orders linear, the whole system is still linear in the linear gas costs and the number of orders, right?
Yes. So the problem is not necessarily the gas costs in terms of the fact that, well, there are concerns with regards to that, but the order issuance in order to insert an order is bounded because there is that depth. So functionally, like if it costs some N amount of gas, let's say it's like 120K in order to do an insert, that's not infinity, right? The problem is principally with matching, which is infinity.
But it is still proportional to the number of orders that are being placed.
Oh, definitely.
Yeah,
We don't have a magic system where you can insert an order.
Matching is long.
So you can't insert 1 billion orders and it all fits in a block.
But
That's not possible. Yeah.
On an AMM, because orders automatically flip when they're crossed, and because you can place orders across a whole range, you don't have costs that are proportional to either the number of prices you're placing orders at or the number of times you get crossed. There's still sort of a different complexity class in that.
Yes. But we're presuming that the cost of insertion is going to be comparable. And additionally, there is this question of, okay, if you have a lot of insertions and cancels on this book, what does that mean? And that's a matter of the spread, right? But in addition, we think with L2s and these new constructions, you could perhaps issue an order on L2, do a cancellation, and it doesn't really bear any real world, well, not significant real world costs.
First of all, thank you very much, guys. Brilliant presentation. I have good news, I have bad news. Good news, I can confirm it does work in practice in the real exchange. The bad news, we run the similar model for about a year now. At ZKX, we separate the execution from batching and matching. The only massive issue in the real exchange is when you have mass automated trading strategies, the cost of order placement goes by order of magnitude. So in your optimization, you've proposed optimization within the one network. What we've seen so far, that in order to keep the cost down for the automated trading strategies, you have to separate execution and keep it, let's say, in our case, it's starting at L2, while matching and batching happens at L3. So maybe consider separation and isolation not in the way of just batching and matching and then execution, but in a different network as well. Because for us, it was the biggest issue with, we only charge fees for the orders that have been matched, but the mass value of orders are withdrawn before they're matched by the automated strategies. So for us, the answer was to just separate between L2 and L3.
I think the separation when it comes to L2 is relevant. What we're specifically talking about is a radix tree construction where the sum value is included.
Right. We're not claiming to have invented separating out matching and execution. Like, we are aware that that has been a thing, like that's a basic, and that's a basic pattern in a lot of smart contracts. Like that whole claim pattern, right? You don't want the contract just automatically like sending things out. So, I mean.
And there is a follow-up for that. In your randomized strategy, you've tested 20,000 transactions. In our case, for some reason, which we're still trying to explore, when it goes about 150,000, it goes exponentially in terms of the cost.
That's what we're solving. That's specifically
that's the optimization we discussed. Yes.
Like we didn't put our contribution today as the separation of claims. This UTXO pattern of an output that you claim at a later time is a pattern that occurs, is a logical pattern for this type of stuff, and definitely we do believe other people have implemented that. It's specifically the radix construct, the keeping everything within 32 bytes, and this sum value that makes it logarithmic.
The matching algorithm.
But it's definitely working, so congrats.
Thank you.
Thank you.
One more question?
So I believe you developed this design with the sort of EVM model where all the computation is going on chain and all the traversals to find the match happen on chain. Other chains, they allow you to do all of that kind of computation to navigate through the tree and stuff in off-chain code without incurring any cost.
Right.
But then for the on-chain validators, you need to prove that wherever you ended up and whatever paths you kind of collected are the valid ones, and you're not kind of, you're not in the wrong part of the tree or whatever, right? How would your design change if you kind of were to lift your constraints in this way, right?
So we have these aggressive constraints because when you offload it to a centralized server, they could do things like censorship. They could preferentially execute with their friends.
Oh, sorry, I wasn't clear. What I meant was, I don't mean that you are trusting someone to do the navigation. What I mean is that the validators, all they care about is that, like in the UTXO model, right? You can say, I'm consuming this UTXO, that UTXO, that UTXO, which is great. It limits you from being able to traverse the entire global data structure because you're limited in the amount of information that you can provide to the transaction, right? But if your data structures in the UTXO model are constructed in a way where you can prove them, oh, I'm actually in the right side of the tree right now, and I'm consuming from it, right? Then you can, all you have to do is show that. You don't have to traverse the whole thing in the on-chain code, right? So how would your design change if you have the ability to just prove that you're in a particular side of your tree without having to traverse the tree in the on-chain kind of execution environment?
So we have this constraint for a reason. We have this constraint because you can, on that off-chain thing, manipulate things in terms of who gets into the tree itself. But if you relaxed it, obviously, you don't have this problem of, block size constraints. So,
Right.
the recommendation would be use more traditional methods.
Okay.
All right. Thanks very much, Joseph and JJ.
Thank you so
And,
much. Thank you.
It's now coming to the first break. Pick up again in 20 minutes with a session on mempool attack and defenses.